Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow with our quarterly call. And today we're going to spend a little time on the economy. I think there's things that you probably know, but a lot of things you may not know that are going on right now and how that relates to the bond market and the stock markets. Let's go to the economy and take a look at a couple of things. Number one, if you'll notice here, all of a sudden disposable personal income is back down. It's going down, okay? And that's because if you looked in 2020 when we gave everybody money, not only companies, but people, organizations, and everything. 21, we also gave money away. And now we come into 2022, and all of a sudden we're not giving any money away. So you're seeing personal income go down quite a bit. And as a percentage of savings, you're also seeing that back to levels that were actually lower than 2018 or 19. The other thing you'll notice is that from a business standpoint, and if you look at this from our friends at McVane, you'll see what happens is proprietors' income, which is small businesses, medium-sized businesses, their incomes are going down. Why are they going down? Because most of their costs are going up. And so from a business owner standpoint, they're not doing as well. You'll also see that for companies in the public realm, okay, if you look at basically the fourth quarter 2021 profit margins, they were 13.5% roughly. That's probably not going to stay that way because you're going to see a lot of their input costs, wages, materials, everything that goes into that, fuel, going up, and those margins probably will come down. And you'll see that's the highest margins we've really seen in many, many decades. Can't stay there in our opinion, and I think people see that from last year, but don't understand that that's not the norm at all. The next thing you'll notice is that if you look at the average 30-year mortgage today, it's up around 4.9%. So that house payment is going up a lot just by the payment of the interest rate alone, okay? And what that's done, if you add that in with what's going on in the price of housing, you'll see in this chart where mortgage applications for mortgages are 50% of what they were just 15 months ago in January 2021. What that means is, and you're going to hear a lot of people say, well, it's not a big deal because we have a lot of people buying bill for rent for cash and that sort of thing. Well, that's true. That's happening out there, but you need this part of the market really. And it tells you that what's happening with people is they're going to get jammed up. Let's say that 70% of the mortgages today are under 4%, all right? So if I'm going to move and I'm going to take another job or I want to move into another neighborhood, etc., can you see how that's going to affect things? That means that if I'm going to sell my home, which is going to mean the buyer's going to have to pay more for that payment, and then I'm going to get another mortgage, all of that fits into a slowing, and we see that affecting things. So if you go into the bond market, I want to mention something here that's really important. If you look, I'm going to just pull out the 2-year bond. This is a 2-year U.S. Treasury. If you look at the 2-year U.S. Treasury where it was 0.16 a year ago and today it's 2.36, okay, or within the past week. What does that mean? For us, it means that the Federal Reserve quarter movements, okay, a quarter at a time, there's 8 of them already in that price. So all of these people that think, well, hey, that's going to come and blow it up, this, that, and the other, we feel that a lot of it's already priced in. And that's why you saw in a lot of our portfolios in all categories, you saw us take and buy more of the 6-month Treasury and the 1-year Treasury. One was over 1%, the 1 year, the 6-month over 1%, the 1 year, 165 or so. That's the best numbers we've seen in a long time. And let me say this to you. We haven't seen many times when the Treasury rate was higher than the CD rate, but it happens. It happens once in a while. Not too often, but that's what's happened in the last 3 or 4 weeks. The second thing in the bond market I wanted you to see, look at where the yield curve of U.S. Treasuries was a year ago and where it is today. Now, what happens on this, you'll see the tremendous moves in the 2, 3, and 5-year Treasury rates. But I want you to notice on the long end, and think about this, if these go up 2% on the short end, but a long end only goes up 10 basis points, that tells you that what's coming is obviously the inverted curve that you can see on the blue line. And secondly, that means the long rates for us are going to keep on drifting lower eventually since we've moved the short rates up. You want to own really some of that paper. You can own a lot more of the 1 and 2 year, but probably for a hedge, you need to own a little bit of that longer bond too, which we do have in all of our income portfolios. Let's see how that affects the stock market. The first quarter was really the worst quarter that we've had in the S&P 500 in 2 years. It was also the first quarter in many, many quarters that we've had stocks and bonds both down in the quarter. And if you look at the average bond fund, it was down almost as much as the average stock fund in some cases. Now the NASDAQ, which had a lot of high-flying growth stocks, a lot of the companies too that don't really make any money, was worse. But the Dow, the S&P, everything was down in that particular period of time. What we noticed was this. Last year in 2021, and this was from a Bloomberg piece that noted that the money that came into stocks in 2021 was equal to more than the last 2 decades combined. So in the 20th year, we had more than the prior 19. What we did was we drew a red line here on this market. We used the NASDAQ, for example, and you'll see that most of that, 3/4 of that of the year, is higher than the market is today. Now, what does that mean to us? That means that those people are underwater that put all of that money in 21. At best, they're break even, if they're even that, and they probably put some overseas, and if they did, they're really getting hurt with that. So all of that bulk money is up above the market right now, probably gives you a ceiling to where people are like, you know, I'm sort of getting closer, I think I'll move that out. It also gives you in a situation where if you get deep moves in the market on the downside, they'll be the first people to pull the trigger to move out. The other thing I want you to notice is that if you look at the current price earnings multiple of the S&P 500, it's obviously out of bounds. In other words, out of a standard deviation above 20.1. It was. It's just barely back to it right now. But if you look at the average multiple of about 16.5 or so, and then let's say a multiple that's cheaper at 13.5. Well, we're up close to 20 and cheap is 13.5. That gives you an idea about how much room in the market you have, that if you just go back to the norm, I'm just saying we go back to the midline or we go back to the lower line, you know, that's something between 20 and 30%. Are we going there? I don't know. Could we? Yes, easily go there because the market does that. It goes back and forth. Last thing you'll look at here relative to that is that if you look at the top 10 stocks that are really in the S&P 500, and you know all the names, you've seen them before, and you look, they're roughly about 31% almost of the total market capitalization of the entire 500 stocks. 10 make up, let's say, a third almost, just those 10, all right? So what you're buying is you're buying into this huge move right at the very group that's right at the top. And if you'll see on the lower graph, they account for about 24% of the earnings also. So as you go through the year, if all of a sudden margins are shrinking, earnings are coming in, and you're comparing against something last year, which is not going to compare well because that was a big, big quarter in the second, third, and fourth quarter last year. That's where you run into comparison troubles. And so what happens is you look at this, and I know most of you investors probably are not aware of this, but you know, Delbar puts out a lot of information. We have to get this from JP Morgan, but it's the same graph. And what happens is if you look at the S&P 500 return for the last 20 years, it's about 7.5%. I would venture to say, if I ask you that question one-on-one and said, what do you think the market return's been in the last 20 years? every one of you would probably say more than 7.5. Why is that? It's because the first 12 years, you didn't make any money at all. You went down, you went up, and you went back down. And so you finally came up to break even at that point in time. And yes, the last 5 years, everybody's, high-fiving. It's been fantastic. But realize that going forward, it won't be that easy. And if you look at the average investor who moves around at the highs and lows, look at where they were, 2.9%. Now, they're all on easy street right now because their 401ks and their personal accounts are really move well. Not this year, by the way, but 19, 20, 21. Okay, they had great periods, even with the 1 month where they slapped the market back in March of 20. So what happens is, if I give you a summary of where we're thinking, okay, number one, we think that the Federal Reserve moves, a lot of that's already discounted in the short-term rates where they are right now. If you told me from this point that we were going to tack on another 2.5%, let's say, on the 1 and 2 year bonds, I would tell you that we will definitely be in recession if that happens. We've got almost 90 trillion of debt all the way around in this country, including federal, personal, mortgage, everything. 90 trillion, okay? Moving rates affects that stuff, and we've got a lot of junk debt out there. If you look at junk rates right now, they're starting to spread wider and wider. Why is that? Because people know there's some of those companies, they won't be able to pay off. There'll be some bankruptcies coming in those companies because they can't stand the higher margin, the higher rates on those margins. Secondly, we think the economy is slowing probably more than people expect, and we've given you some reasons for that in this call. And we do not think that is priced in at this point. So surprises like that are what affects the markets. What has that made us do? That's made us take a more defensive position in every single strategy, all three strategies. You've recently seen some things from Chance Finucane, our Chief Investment Officer. Chance has done a good job of getting our equity portfolios in a more defensive position. We've done the same thing in high income and in the conservative strategy. And so we think we're really well positioned for what could be some surprises. And lastly, we feel like the cash we have will put us in position to really be more aggressive later in the year. We think there'll be some opportunities for us to really do some good, find some things that are really cheap. And we look at these sell-offs as opportunities. We don't look at them, hey, the world's coming to an end. That's just part of the market. It ebbs and flows. Has not had a lot of ebb in a long time. However, we think it will. We think a lot of things are going on this year are going to change that. So we hope you understand where we are, what's going on with us. But if you want more detail on that, we would certainly like for you to contact us. Either call us or visit us at our website, oxbowadvisors.com. So until the next quarter, thanks for watching this, and we'll see you next time. Thanks.